Welcome back to my channel. It's always great to have you here. Every time we gather like this, I think of it as more than just a conversation about markets or investments. It's a shared exploration of how the world really works, how hidden forces shape outcomes, how cycles repeat, and how patterns from the past whisper to us about what may come next. And today, we stand at one of those fascinating intersections where history, psychology, and economics all converge. If you pause for a moment and imagine yourself on the edge of a great turning point, you can sense that something about our current system feels stretched. That's because at Island, one of the clearest signals of imbalance today lies in something deceptively simple, the gold-to-silver ratio. At first glance, it looks like a dry statistic, the number of ounces of silver it takes to buy 1 ounce of gold. But like many things in life, what appears simple at the surface often hides profound lessons underneath. This ratio is more than a number. It is a mirror reflecting centuries of human behavior, trust, scarcity, and the ways we assign value. For most of history, the gold-to-silver ratio hovered within a certain band, usually shaped by natural scarcity and mining realities. You could count on it the way sailors once counted on the stars stable enough to navigate by. But in today's markets, it has stretched far beyond that historical anchor, recently rising to levels above 100 to 1. In other words, silver, measured in price, is trading at less than 1/100th of gold's value. This isn't just unusual, it's extreme, one of the widest gaps ever recorded. And when things become extreme, history tells us that change is not only likely, it is inevitable. Now, here's why this matters. Markets, like people, seek equilibrium. When something drifts too far from balance, pressures build until eventually they snap back. We see it in economics, in politics, and even in our own lives. Think of times when you've ignored your health, or a relationship, or your finances for too long. The imbalance always demands correction. The gold-to-silver ratio is flashing one of those signals today. It's telling us that perception and reality are out of sync and that the path ahead may involve a sharp realignment. But this story isn't just about numbers. It's about how cycles unfold, about how opportunities emerge precisely when most people have stopped paying attention, and about how assets like silver can suddenly shift from forgotten to essential. To understand why, we need to look not only at the mechanics of markets, but also at the psychology of those who drive them, the fear, the herd behavior, the neglect, and then the sudden rush when recognition dawns. In that sense, what we're about to explore is not only an investment narrative. It's a broader reflection on how we assign value, how imbalances creep into systems quietly, and how those imbalances eventually correct themselves, often with more force than anyone expected. Silver is at the heart of this story, not as a footnote to gold, but as a central player in the next chapter of how economies adapt to new realities. So as we move forward, I invite you to approach this not simply as an analysis of precious metals, but as an exercise in seeing patterns that govern markets, history, and life itself. Because when you start to see the world through these recurring cycles, it becomes less about prediction and more about understanding. And understanding is the first step to preparing wisely. Let's dive in. The gold-to-silver ratio may sound like a technicality, but in truth it functions like a seismograph quietly recording the tremors of financial stress and shifts in perception long before most people notice. It is simply the number of ounces of silver required to purchase 1 ounce of gold. Yet beneath that calculation lies centuries of context. For much of recorded history, societies intuitively recognized a kind of natural order between these two metals. In ancient Rome, for example, the ratio often sat near 12 to 1. During the 19th century, under the bimetallic standard, it hovered closer to 15 or 16 to 1. even into the early modern era. It rarely strayed far outside the 20-to-1 range. Why? Because those levels reflected both the relative scarcity of each metal in the earth and the cost of bringing them out of the ground. Gold was rarer, silver more abundant, but both were trusted as money. This natural balance, though never perfect, offered a kind of gravitational pull that kept the ratio within certain bounds. Contrast that with today. We are not talking about 12-to-1 or even 20-to-1. In recent years, the ratio has ballooned past 80, 90, and even briefly touched over 100-to-1. This means silver is priced at less than 1/100th the value of gold, a spread so extreme that it strains not only logic but also historical precedent. And what history shows us is that when this ratio stretches too far, it rarely stays there. Just as a rubber band pulled to its limits must eventually snap back, the gold to silver ratio tends to revert toward more moderate levels. That process is not smooth and it is not gentle. It is often sudden, violent, and transformative. To appreciate this, consider past cycles. In the early 1,980 seconds, during a period of monetary stress and inflation, the ratio collapsed from around 80 down to near 15. Silver prices surged nearly tenfold in the process. In the 2,000 seconds, the ratio again fell sharply from above 80 to the 40 seconds, rewarding silver holders with multiples of the gains gold investors enjoyed. These are not anomalies. They are examples of a broader principle at work. When imbalances grow too large, corrections don't just level the field, they swing the pendulum dramatically in the other direction. What makes the ratio so powerful is not just its statistical tendency, but what it reflects about human behavior. Gold is viewed as the ultimate store of wealth, the safe harbor in storms of uncertainty. It is hoarded by central banks, treated with reverence by cultures, and largely sits idle in vaults. Silver, on the other hand, wears two faces. It is both a monetary asset and an industrial input, consumed by technologies that define modern life from solar panels to smartphones. When fear rises, capital floods into gold, leaving silver behind. When optimism returns, silver catches up quickly, and because its market is smaller and more volatile, the move is amplified. That is the essence of mean reversion in this context. It is not a mechanical formula. It is the rhythm of psychology. People crowd into safety when uncertainty peaks, pushing the ratio higher, and then crowd back into risk as the outlook stabilizes, pulling the ratio lower. The cycle repeats over and over, each time leaving behind lessons for those willing to study it. The deeper point here is that the ratio is not just about metals, it is a metaphor for imbalance itself. In markets, in economies, and in life, when things drift too far from equilibrium, forces accumulate that eventually restore balance, sometimes gently, sometimes explosively. Think of a business that grows complacent with too much debt, a society that overextends its promises, or a person who neglects their health. The longer the imbalance persists, the more dramatic the correction becomes. Today's gold to silver ratio is one of the loudest signals of imbalance in the financial system. It tells us that silver is not just undervalued, it is neglected. And neglect has a way of flipping into recognition almost overnight. When it does, the adjustment can be swift and rewarding for those who understood the lesson ahead of time. The important question is not whether the ratio will correct, it always does in some form. The question is when and how. And that leads us to the next layer of this story, the unique nature of silver itself, the very reason why this imbalance is so striking in the first place. To truly understand why the gold to silver ratio has stretched to such extremes, we need to look beyond the numbers and into the essence of silver itself. Unlike gold, which plays almost entirely in the monetary world, silver lives a double life. It is both a precious metal and an industrial workhorse. This dual identity is what makes it so misunderstood, and also why it carries such profound potential when conditions align. Gold's story is straightforward. It sits in vaults, in jewelry boxes, in the reserves of central banks. It is a symbol of permanence, of stability, of something beyond the noise of daily life. That's why in times of crisis, money rushes into gold. It does not tarnish, it does not corrode, it does not get consumed. Almost every ounce ever mined still exists somewhere in the world. Silver, on the other hand, is different. It has always had monetary qualities, but it has also always been useful. And in the modern world, its usefulness has expanded dramatically. Consider the technologies that define the current era: solar panels, electric vehicles, smartphones, medical devices, advanced electronics. Silver is embedded in all of them. In fact, it is the most conductive metal known to science, which makes it irreplaceable in an age where energy and information flow are the lifeblood of progress. Every solar panel requires a measurable amount of silver paste to conduct electricity. Every electric vehicle uses far more silver than a traditional car. Every circuit board, every connection that demands reliability often depends on silver. And here lies the paradox. While gold largely rests untouched, silver is constantly being used, dispersed into products that will not return to the market for decades, if ever. When an ounce of silver is locked inside a solar panel, it is effectively removed from circulation. This consumption makes silver fundamentally scarcer than gold over time, despite its lower price. We are, in a sense, living through a quiet drain of available silver stocks, even as its role in shaping the future grows larger. This is why calling silver poor man's gold misses the truth entirely. Gold preserves wealth. Silver enables progress. It bridges two worlds: the psychological world of money and trust, and the physical world of wires, panels, and devices. Few assets carry this dual role, and that's what gives silver its extraordinary leverage in times of transition. The market, however, often struggles with this complexity. Investors tend to favor clarity. Gold's story is easy. Hold it when times are uncertain. Silver's story is nuanced, tied to both economic cycles and monetary tides. When global growth slows, demand for industrial metals falls, and silver gets punished alongside copper or aluminum. This cyclical weakness often masks its deeper structural strength. But when economies pivot toward expansion, particularly in areas like renewable energy and electrification, silver's industrial demand accelerates just as investors start recognizing its undervaluation. At that point, its dual identity turns from a burden into a tailwind. Think about the era we are living through now. Nations around the world are setting ambitious targets for decarbonization, pushing solar energy capacity to unprecedented scales. Electric vehicles are no longer fringe experiments, but mainstream commitments. Digital infrastructure is expanding, requiring ever more reliable conductors. All of these trends converge on silver. It is not speculative demand that can vanish overnight. It is real, physical, structural demand embedded in the technologies of the future. And yet, the price of silver remains shackled by an outdated perception that it is simply a sidekick to gold. This is where opportunity is born, when reality and perception diverge so sharply that the market's narrative lags behind the fundamentals. Silver's dual identity ensures it will always be volatile, always pulled between its roles. But it also ensures that when recognition finally arrives, the repricing can be dramatic. This is the essence of silver's story, a metal that does not fit neatly into one box. It is wealth and utility, trust and technology, past and future. To ignore one side of its identity is to miss the full picture. And as we turn to the forces of supply and demand, we will see that This dual role is not just a curiosity, it is the very reason the pressure building beneath the surface feels so inevitable. Every market tells a story of balance or imbalance between supply and demand. With silver, that story has been building quietly, almost invisibly, like steam gathering inside a pressure cooker. And if history has taught us anything, it is that such pressure never stays contained forever. On one side of the equation, we have supply. Global mine output of silver has been struggling for years. Unlike gold, silver is rarely mined on its own. It is most often a byproduct of extracting other metals such as copper, lead, or zinc. That means silver production does not respond quickly to higher prices. Even if demand surges, miners cannot simply flip a switch and flood the market with new supply. The economics of other metals dictate the pace, and investment cycles in mining are long, often stretching 5 to 10 years before new capacity comes online. Recycling offers some relief, but not nearly enough. Much of the silver embedded in electronics, solar panels, or medical devices is dispersed in tiny amounts and too costly to recover. Once used, it is effectively gone for decades. On the other side of the equation, demand is compounding at an extraordinary rate. The renewable energy revolution is not a forecast, it is underway. Every solar panel being installed across rooftops and fields contains silver. Multiply that by millions of panels each year, and the numbers become staggering. Electric vehicles are another catalyst, with each unit requiring 2 to 3 times more silver than a conventional car. Add to this the continuous expansion of 5 grams networks, electronics, and medical technologies, and what emerges is a structural demand curve that keeps bending upward. This is not speculative buying that can evaporate with a change in sentiment. These are hard, physical requirements of the technology shaping our collective future. And unlike investment flows, they do not wait for price corrections. They are necessities. That's what makes the imbalance so profound. Meanwhile, inventories are thinning. The deficits of recent years, where annual demand has exceeded supply, have been quietly drawing down above-ground stocks. Warehouses that once provided a buffer are now leaner, and that cushion is shrinking. Unlike gold, which mostly sits unused in vaults and can be mobilized if prices rise, silver is consumed. Once locked into a circuit board or a solar array, it does not come back in any meaningful volume. Scarcity, in silver's case, is not just theoretical, it is physical and compounding. This is where the metaphor of the pressure cooker becomes apparent. Imagine a sealed pot over a flame. The heat builds slowly at first, and the pot seems calm, but inside, pressure is rising. The longer it builds, the greater the force when the release finally comes. Silver's market today is that pot. Constrained supply on one side, rising structural demand on the other, and inventories acting as the thinning lid in between. At some point, the equilibrium will not hold, and the release will be sudden, often violent. Prices do not glide upward in such scenarios. They leap. History offers parallels. In the 1,970 seconds, when inflation and industrial demand collided with limited supply, silver prices erupted, climbing nearly tenfold in a few short years. In the 2,000 seconds, as renewable energy and investor flows converged, silver surged again, outpacing gold by wide margins. Each time, the catalyst was the same, a mismatch between what was needed and what was available. Today, those dynamics are not only present, they are magnified by global megatrends. Decarbonization, electrification, and digitalization are reshaping entire economies. These are not fads. They are structural transformations, and silver is woven into each of them. When we step back, it becomes clear that silver's current price does not reflect these realities. The pressure is building quietly but persistently. And like the pressure cooker, the longer it takes to release, the sharper the adjustment will be when it comes, which raises the next question. How does the market respond when that adjustment begins? For that, we need to explore the role of momentum and psychology, the forces that turn slow recognition into sudden rush. When pressure finally releases in a market, the shift is rarely orderly. It's not a gentle repricing that calmly reflects new fundamentals. It's a cascade of recognition, a rush of capital, and a swing in psychology that transforms neglect into enthusiasm almost overnight. That's what momentum really is, the visible footprint of human behavior adjusting to reality. And in silver, momentum has already begun to stir. After years of lagging behind gold, silver has recently shown bursts of life, rising over 30% in just a few months, reaching levels not seen in more than a decade. At first glance, that might look like noise, a short-term rally, but history teaches us that these initial moves often signal something deeper. They mark the moment when the market begins to wake up to what the fundamentals have been signaling for years. What makes momentum so powerful is its feedback loop. Rising prices attract attention. Attention draws in new buyers. New buyers push prices higher still. And each move upward validates the thesis for those waiting on the sidelines, who then pile in themselves. This self-reinforcing cycle is not irrational, it is human. People act when they see confirmation, not just when they hear an argument. And markets, being collections of people, reflect that same rhythm. Technical patterns on long-term charts, like the classic cup and handle formation, may sound esoteric, but they are simply the visual expression of accumulation. Large players quietly build positions during years of consolidation, while the impatient leave the market in frustration. Then, when prices break out of those long bases, momentum accelerates as the quiet accumulation transforms into public recognition. Silver's charts are now flashing precisely those kinds of signals. The psychology behind it is equally important. For much of the past decade, silver was treated as gold's erratic cousin, too volatile, too unreliable, always failing to sustain rallies. Investors grew weary. Many walked away. That neglect was itself a stage of the cycle. In markets, as in life, neglect often creates the soil for opportunity. Because when sentiment is low and the crowd has given up, the groundwork is laid for outsized moves once conditions shift. We are now at the early edge of that shift. Analysts who once dismissed silver are beginning to call it the trade of the decade. Fund flows are picking up. Retail interest, long dormant, is showing signs of rotation. And in India, a country with deep cultural ties to precious metals, silver has already outperformed gold this year, something that rarely happens without broader momentum behind it. But here is the paradox. Momentum is both the opportunity and the risk. Silver's smaller, more volatile market means that when capital floods in, moves are amplified far beyond gold's. That's why silver has historically delivered multiples of gold's returns during bull phases. Yet it also means corrections can be brutal. Momentum cuts both ways. Those who chase without a framework often get shaken out during pullbacks. But those who see momentum not as random speculation, but as confirmation of a structural thesis, understand it differently. For them, volatility is a feature of the process, not a flaw. When you step back, you realize that momentum is not just about price charts, it's about recognition. For years, the fundamentals have been whispering. Deficits are growing. Industrial demand is compounding. Inventories are thinning. Momentum is what happens when those whispers finally become visible enough for the crowd to hear. And once that recognition begins, it tends to carry much further than most expect, often into the realm of overenthusiasm or even mania. This is why the recent surge in silver is not just another rally. It is the visible tip of a larger adjustment process, a shift in both narrative and psychology. And if history is any guide, these early signs are less the conclusion than the prologue. Silver's story is not finished. It is only beginning to be written. But before we look ahead to where this momentum may lead, we need to confront a deeper truth about silver, one that defines both its greatest strength and its greatest challenge. That truth is its volatility, its high beta nature, and the lesson it carries for anyone seeking to harness its potential. Silver has always lived with a reputation, the wild sibling of gold. Where gold is steady, silver swings. Where gold reassures, silver unsettles. And while this reputation might keep cautious investors away, those who understand the mechanics of volatility know it's not merely a risk. It is also the very reason silver can deliver extraordinary returns in the right environment. Historically, silver's beta to gold, the degree to which it amplifies gold's moves, has ranged between 1.5 and 2. That means when gold rises 1%, silver often rises 1.5% to 2%. The opposite is also true. When gold declines, silver tends to fall harder. This magnification cuts both ways. It explains why silver often lags in the quiet phases of a cycle, but also why it outpaces gold dramatically when conditions turn bullish. In strong markets, silver doesn't simply follow gold, it multiplies the outcome. To understand this, you have to look at the market structure. Gold is supported by large, stable holders, central banks, sovereign funds, long-term investors who view it as monetary insurance. This creates a base of demand that is less sensitive to short-term shifts. Silver, by contrast, has far less institutional sponsorship and is more heavily influenced by both industrial cycles and speculative flows. Its smaller market size means even modest shifts in demand can create outsized price moves. This is why silver feels explosive when trends accelerate. It is a market where liquidity itself amplifies momentum. But volatility is not just a financial concept, it is a principle of life. Think about growth itself. It rarely happens in straight lines. Businesses expand in fits and starts. Economies cycle through booms and recessions. Even personal growth often comes through setbacks and breakthroughs rather than smooth progression. Volatility, in this sense, is not an anomaly, it is the natural rhythm of change. The same applies to silver. Its wild swings are not flaws. They are expressions of its dual identity and constrained market. For investors, this creates both temptation and fear. The temptation is obvious. In past bull cycles, silver has generated returns several times larger than gold. The fear is equally real. Its corrections can be sharp enough to test conviction, but therein lies the deeper lesson. Volatility punishes those who lack perspective, but rewards those who can see beyond the noise. In silver, patience is not just a virtue, it is a necessity. And here's where the opportunity lies. Silver's volatility acts like leverage without leverage. Investors don't need to borrow capital to amplify returns. Silver itself provides that amplification. The key is not to fear the swings, but to understand them, to embrace that the very characteristic that unsettles most is also what creates its extraordinary upside. So when we ask the question, could silver outperform gold by 9 times, it's not about prediction with certainty. It's about recognizing the ingredients of such an outcome: extreme undervaluation, rising structural demand, thinning supply, shifting momentum, and the amplifying force of volatility. All of these forces are in play today. The road ahead may not be smooth, it rarely is, but opportunity rarely arrives dressed in calmness. More often, it comes cloaked in uncertainty, volatility, and doubt. Silver's greatest act may not simply be about outpacing gold. It may be about reminding us that imbalance always corrects, that cycles always turn, and that volatility, though uncomfortable, is often the birthplace of transformation. So I leave you with this thought. The question is not just could silver outperform gold by 9 times? The deeper question is what will you do if it does?